Namaskar, welcome. Home and corporate loans are soon going to cost less after banks transmit the RBI rate cut. Now, the RBI cut benchmark repurchase rate from 7.25% to 6.75%, its lowest in 4.5 years. It was the fourth bi-monthly monetary policy review for the current fiscal, and RBI has clearly aimed at bolstering the economy.
It's a significant Tuesday as RBI Governor Raghuram Rajan has kept CRR unchanged at 4% but has made headlines when he slashed policy rate by 0.5% to 4-year low of 6.75%, which means that repo rate, the rate at which the central bank lends to the banks, has been cut by 100 basis points this year. It has to be noted that the first two cuts of 25 basis points each in January and March were both outside of the policy review schedule. With a cut of 0.5%, the reverse repo rate settles at 5.75% now.
Therefore, the Reserve Bank has front-loaded policy action by a reduction in the policy rate by 50 basis points. Given our year-ahead projections of inflation, this ensures that 1 year expected Treasury bill real interest rates of about 1.5 to 2%, which we think is appropriate for this stage of the recovery.
A quick look at the parameters will show why the RBI governor budged this time. The CPI and the WTI were on a decline, and growth and IIP exerted pressure. And these factors sparked the expectations of a rate cut from the RBI governor. Eyeing to tame inflation figures, the RBI governor expects inflation to reach 5% in January and to stay below 2016 target of 6% in financial year 2016-17. RBI, however, treaded cautiously on the growth target as it lowered the growth estimate to 7.4% from 7.6% for financial year 2016. The SLR also remains intact at 21.5%. The governor foresees a fall of 1% in SLR within the next year. The surprise move by RBI governor will spell cheer for consumers as it would lead to lower home, auto and other existing and new loans.
The January 2016 target of 6% inflation is likely to be achieved. Therefore, the focus should now shift to bringing inflation to around 5% by the end of fiscal 2016-17.
The central bank also said that global growth and trade slower than initial expectations have led to continuing lack of appetite for new investment in the private sector, the constraint imposed by stressed assets on bank lending and waning business confidence. The rate cut assumed significance as the ease rates would enhance this appetite for new business and give more teeth to Prime Minister Modi's Startup Stand Up India initiative. Preeti Kaur, DD News.
Well, government has welcomed the RBI's decision to slash the repo rate.
The government welcomes the RBI's decision to reduce the repo rate to 6.75 from 7.25%. There will be a need to have a constant vigilance now on the inflation front.
Well, and the Finance Minister Arun Jaitley also said that inflation has moderated and is under control.
This decision of the RBI actually implies that inflation pressures have moderated significantly and are now within the comfort zone. The government is fully committed in meeting the fiscal deficit targets in order to consolidate the gains achieved by the contained inflation.
Well, and to understand why this rate cut was necessary and its impact on the economy, to find out what kind of impact it will have, we have with us Nitin Desai, former Chief Economic Advisor, and Anil Padmanabhan is the Deputy Managing Editor of the Mint. Thank you very much, gentlemen, for being with us. We'll start with you, Mr. Desai. Now, most economists were predicting a 25 basis point cut, but Mr. Raghuram Rajan does what he does, as he says, and he's done 50 basis points.
I think he did this basically because he wanted to push the banks into passing on the rate cut. What had happened last year, he cut rates by about 0.75%.
Right.
And the median rate, lending rate of banks actually came down only by 0.3. 30 basis points. And he has been saying things about this, saying why are the banks not passing it on. So I think he decided to do this so that it would push the banks into actually reducing rates. Because that's what matters to the borrower.
Mr. Padmanabhan, why were the banks not passing on the rates earlier? What was it? Because they were concerned about NPAs, or let's say, were they putting more pressure on the RBI to make a bigger cut like this so that they
add to what Dr. Desai was saying, that I see several strands from this policy statement. One, the threat of inflation seems to have abated quite officially now, for the fact that the Reserve Bank of India has said so. Secondly, more worrying for me is that the rate cut actually carries a warning on the economy on the downside. So this is more recognition of the Reserve Bank of India of what the Chief Economic Advisor Arvind Subramanian had said. He was worried about deflationary tendencies in the economy. So I think this is the Reserve Bank's tacit acknowledgement that there is a downside risk to the economy given a host of considerations.
Yes, Dr. Desai, well, let's understand, WPI was a negative. Was that a sign that there was deflation, or because there's some misunderstanding about deflation and disinflation.
Yes, basically, technically, deflation is when you get two consecutive quarters, and one doesn't have to go into the technicalities.
Yes.
The simple reality is there is a shortage of demand, but there's a problem of demand growth. If you look at the reasons that have been given for the stalled projects, the lack of demand growth is the biggest single reason, and loss of promoter interest. We did an analysis of the 800 projects recently. So I would say that it doesn't matter whether you call it disinflation or deflation. There is a problem. We look at credit growth. Credit growth to the industrial sector and the services sector in recent months has been half of what it was in the corresponding month last year. So there is a strong problem of credit offtake. The problem also, which Anil mentioned, the fact that the banks are stuck with a lot of NPAs because of this lack of demand growth. So I would say, yes, I think the government is right to be concerned. Rajan is right to be concerned about this. And one hopes that this will stimulate some. Initially, probably it will stimulate consumer demand. I don't see this immediately translating itself into people suddenly deciding to start new projects. But initially, it will probably show itself up in an improvement in the outlook for. We started already with consumer durables, cars, etc.
Mr. Padmanabhan, chicken and egg situation really, because the stalled projects were expecting more credit to take off or to restart or whatever. And the banks were concerned about giving out that credit because, there could be NPAs. But now what do you think? Will the stalled projects take off? The ease of doing business is improved. There's investment climate is improved. Money coming in from abroad.
I think you should take the cue from where you left off on demand. There's a clear demand crisis in the economy. So there are two ways you can stimulate demand. One is the state investment, that is the government of India, which the union budget has clearly signaled, and from all the road projects that we are seeing where closures happening, there is a huge push at the state level, which is playing down the line. The other side is a private consumption issue, which is where the rate cut plays into the whole argument. And then on top of this, you must add the pay commission that is coming. So there is overall a serious potential for a demand stimulus in the economy. And once demand picks up, then these projects get unlocked and then the cycle begins to flow. So the clear economic strategy now is to address the demand constraint. And you must also read in the RBI policy statement, he says the Indian economy is operating at a low capacity. I heard the Deputy Governor saying 70%. So which means there is enormous slack, which just reinforces that if there is a demand boost in the economy, it won't necessarily be inflationary.
So let's look at that question of inflation, because he does say that the target for 2016 will be met at 6%, and he wants to bring it down to 5%. What is an ideal level of inflation that can be considered good for growth?
It's very difficult to say whether 5% is good, 6% is good. All I would say is that in a growing economy where prices have to adjust, relative prices have to adjust, it's always easier to adjust relative prices in a situation where there is a slight inflationary trend than to try and adjust relative prices in a situation where some prices actually have to fall Here you simply have to have differential increases. Look, this sounds slightly technical, but just to think of agriculture.
Okay.
Now today you are seeing a shift of demand from, let us say, cereals to milk and fruits and vegetables.
Right.
If I had a situation where actually cereal prices would have to fall in order to allow these prices to rise, that will be very difficult. But if I just have differential inflation, which is what we've had so far, that essentially cereal prices are moving up more slowly than, let's say, fruit and vegetable prices or milk prices. And that way the relative price adjustment takes place, resources shift to the things which are in high demand. So I would say it's difficult to say what you require, whether it's 5%, 6%, 4%.
Sure.
But look, let's live with 5%. More than 5%, if you get to double digit, you have other problems.
Right.
With double digit, you start running into macro problems. So I would say this 5% is a reasonable sort of number to work with.
Okay. One of the concerns about monetary easing is that, it lends to a lot of speculation on the markets, because that's what has been the policy of easing in the West. That has now flooded the markets with so much extra money and trillions of dollars, which is just moving up and down and creating a lot of volatility. Is there a concern, when he says that he looks at the Fed policy as one aspect of watching, is this some sort of a concern? Because, over the years, people are judging economies based on how the markets are moving, the stock markets, not how the real economy functions.
I presume you're referring to the global, the QE.
The global, yeah.
So definitely. I mean, I think there are 2-3 global factors.
We are also affected by that because of the globe. We are integrated, yes.
Definitely the Reserve Bank of India has factored global issues in their decision today. The US Federal Reserve. US Federal Reserve will raise rates. It is a question of timing. And it won't be one, it will be several, because that's the state of economy there.
So that's
then there's China. Then there's China. And there's a Eurozone which is also impacted. So overall global demand, we have very clearly said, is squeezed severely. So they have taken that definitely into account. So the Reserve Bank of India is factoring the global liquidity situation, and also this rate hike will also slow down the exit of capital from the equity markets too.
Okay.
So there has been a winding down that we have seen in the last few months, which should definitely ease up with this kind of clarity. And
because
he's talked about some FI relaxation on bonds which are in phases.
Yeah, that's a very important one. What he has done is, at the moment, the foreigners are allowed, there's a ceiling on how much of government securities they can buy here. It's about 1.5 trillion rupees. He has virtually doubled that. In the sense that he has said that by 2018, there will be an additional 1.2 trillion, I think, roughly, on the central government side, and 500 billion on state government side. That means that he is opening up the government securities market to for an investment. And given the gradual improvement in India's credit rating, I would say that this could become quite an important flow and a stable flow. The second thing he has done, if you see what he said, is about allowing Indian corporations to float rupee-denominated borrowings abroad. There's a reference to that, I think, in the policy. So besides this, I think...
How does that help? Is there a demand for the rupee?
No, it's not a question of demand for the rupee.
It's a demand for the...
the exchange risk is borne by your lender, not by you. I get my rupees, I'm spending in rupees. So my liability, because the reason for this is a lot of guys had borrowed low interest rate loans in foreign exchange and are suddenly in trouble because they had borrowed when the thing was 48, 50 rupees to a dollar. And now suddenly it is 66, 67. So you avoid that with the rupee denominator. But there, you'll obviously have to pay a higher margin because, and I think there's some specification on the margin that is permissible on that also. So I would say that the real thing, to pick up where Anil left off, see, basically we are trying to manage things in a situation where you cannot look to export growth to drive demand, the demand engine. And I think there's a recognition that the growth in India will have to come from stimulating domestic demand. I think what he's done will stimulate domestic demand on the consumer side. And once that happens, the demand on the capex, and that is capital equipment side, will also start moving up. But I think this is basically sensible.
Fair enough. Mr. Padmanabhan, you did mention earlier that he was talking about capacity utilization being less, and we expect more corporate investment as well. This can only happen if transmission takes place, isn't it? And what level of transmission as well? Because now today we know that SBI is cut by 40%, by 0.4%, sorry. So 40 basis points. So they are not cutting the entire amount, 50 basis points. So they are keeping that little bit of cushion.
See, the transmission is not. It is a cohesive. I mean, it has to happen in totality. It can't happen that unilaterally that the banks would do. It is part of a larger macro framework. So particularly in that is small savings. So if banks reduce their deposit rates, they are going to face an exit into rival small savings instrument. So it has to be calibrated very carefully. So there, the finance minister said they are reviewing the small savings schemes rates, and they will come out with a policy or a statement on that as and when. He didn't give a timeline on it. So you will see this transmission will be gradual. It cannot be no economic step is it instant. It's not like turning a switch on and off, because you're setting in motion a certain dynamic which will create a further dynamism, and that is how they look.
Right, but Dr. Desai, he's front-loaded the policy action. That's what he says, which means that you're making it, you're putting it on a fast track, isn't it?
Yes, what you're saying is basically normally, if
you want results fast.
If you guys had been behaving yourself, I would have done 0.25 now, and maybe I've done another 0.25 in December. He says, no, I've decided to do 0.5 straight away. I'm flooded, so you do something. But as Anil says, basically, as far as banks are concerned, what matters is the cost of funds to them.
Yes.
Reserve Bank lowering rates does not immediately translate itself into lower costs till they bring deposit rates down. If they bring deposit rates down, then the problem he mentioned, which is that the things may shift to other instruments. So it's going to take a little time. And I'm not surprised that what has happened last year was only less than half of the thing was transmitted, because I think basically banks are rather afraid of bringing deposit rates down because of the fact that there are competing avenues available.
So, Mr. Padmanabhan, what areas will demand increase? Rate sensitive is what they say. I mean, like auto, home, etc. I mean, that's technically what people say, but does it really happen?
See, consumer demand, the bellwether is exactly the commodities you mentioned. So that is where it will reflect. But in the medium term, what will happen is your EMIs should drop. So which should free more money in your pocket. There will be an income effect kind of in your pocket, which means if your inflationary expectations are low, which will be, as more and more people are recognizing that, then your spending will increase, bound to increase. So it's not. I think you don't look for instant responses. You have to factor in a gradual thing, but that it's already building. That momentum is visible to most of us, even if you look very carefully at the data. Even in two-wheelers and all, there is a marginal pickup. You can't say it is a pickup, but there's a marginal. I think so there will be it will galvanize. So it will take time.
Okay, and so when, let's say, incomes, he did mention the next pay commission. So when incomes increase, or when people have more money and they apparently are going to spend more, is this just, I mean, does it automatically happen that, the economy picks up, or
no,
what?
Not necessarily. Yes. Remember this, what he has said about the pay commission is very interesting. What he said, the pay commission will have this demand boost, but the government is committed to holding to its deficit target. If that's the case, then you don't get a demand stimulus. The government cannot pay the extra money the pay commission wants, and yet keep the deficit at the same level without cutting somewhere else. So, in fact, one of the reasons he gives for the monetary stimulus is that you can't count on the...
and we heard the finance minister saying that they're committed to keeping the deficit.
Saying that, which means he'll have to cut somewhere else, because you can't give what the pay commission award could easily be 0.5%.
So, but he has a cushion with the oil prices being so low. So he has about 12,500 crores factored into this. So
but is that for the long term?
Element.
Is that for the long term?
No.
See,
I mean, the oil prices could, it's...
see, that's again...
We have to also factor in, strange eventualities.
The Reserve Bank has said that in its projections that they don't expect global commodity prices to have any sharp reversal for some time.
That's right, yes.
So that's exactly why they have brought down their inflation projections too. So they are giving us actually 18 to 19 months of a good terrain of low commodity prices.
And is that likely to happen because China is going to continue to have low demand for these commodities?
Yeah, if that doesn't, the only reason that may not happen is a sudden revival in growth the world over. That's even better for us than low commodity prices.
Okay.
So I wouldn't worry too much on that front. And I think the government's focus should be to revive private demand, push government investments, and through that stimulate the capex sector, which will then pick up as as projects get taken up, and basically focus on domestic demand growth.
Okay.
If the export demand comes up, but it's quite tough now. Look at diamonds, for instance. Look at the sorry state it is in. So I would say that you cannot count on export demand growth in the short run.
Was there pressure being built up on the RBI to take this decision? Because, I mean, for the longest time, people have been saying, in public statements that the rate cut is necessary. They've been saying it, at various forums.
I think pressure was being brought upon by the RBI by itself. Okay, this is a decision they could have easily taken 2 months back. So by delaying it by 2 months, I don't think fundamentally the macroeconomic outlook has changed.
But there was this concern of the deficient monsoon. Then even now he has mentioned it.
Exactly. So that 2 months ago you had a deficient monsoon. In fact, the deficiency was even worse at that point of time.
Yes.
So I think the pressure was brought upon RBI by itself. It could have avoided that pressure. And yes, this kind of, I don't think, if you step back, having said that, it's not a good thing to pressurize an institution like Reserve Bank of India into taking serious macroeconomic decisions. I think their independence should be respected.
Yeah, I think one of the things which maybe, besides the pressure from, clear pressure from Delhi, I think the other thing was, if you look at the numbers on credit growth to the industrial services sector over 2015, it really is very low compared to the past. And that may have scared him because that hits banks.
Okay.
If the banks don't have that pretty lucrative lending to the corporate sector, then they can get into real trouble.
Okay, just we've run short of time. Two final words from you all. He said that the biggest risk to inflation is on the services side. How do you understand this, and what kind of concerns do we have there?
See, services are the biggest chunk of your economy.
Yes.
So naturally, if the service sector is impacted, it is going to. So he's basically talking about a host of our services like telecom, for example, which are all, a lot of them are inputs into commodities nowadays. So I guess that's what he's referring to, because he has not elaborated.
So that's necessarily a bad thing, or what? I mean,
again, like he said, it's a calibration, so it is sectoral. So I don't think you can take any in isolation.
And he said that the best protection against all this turmoil is good policy. So is this good policy?
I think he's good. I think he's a good man, and he's done the right thing. As Anil said, most of us wish that he had done this a little earlier.
Okay.
But I suppose a few months is nothing between friends.
Okay, we'll leave it there. Thank you very much, gentlemen, for being with us. Well, India's largest bank, the State Bank of India, has already slashed its minimum lending rate, or the base rate, by 0.4% to 9.3%. Now, this sets the stage for others to follow suit. Now, the rate cut will come into effect for SBI from October 5, and it will be cutting fixed deposit rates also by 0.25% across various maturities. This is also from October 5. Andhra Bank also reduced its base rate by 0.25% to 9.75%. This is effective from today. And soon after the RBI policy announcement, the Finance Minister Arun Jaitley expressed the hope that banks would transmit the benefit to borrowers so as to boost investments and the economy. Let's hope this monetary easing by the RBI puts the economy on a high growth path. Thanks very much for watching. Namaskar.